Hi, everyone. This is Jason Barrack of Wall Street for Main Street.
And this is Lee Justo from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 20. We're recording this on Wednesday night, May 17th, 2023. Lee, the U.S. Treasury is apparently down, I think, to our last $85 billion in the Treasury General account. And do you think Janet Yellen is panicking about the debt ceiling?
I don't think anyone's really panicking about the debt ceiling. I mean, it's probably the phoniest news story ever in my eyes. I mean, they've actually raised the debt ceiling 78 times since 1960. That's more than once a year. I mean, does anyone really think that there's an actual debt ceiling anywhere?
It's Kabuki Theater. I mean, both political parties, they hem, they haw, they fight in public. It's like Jesse Ventura used to say, talk about both political parties. For those that are not familiar, Jesse Ventura used to be a professional wrestler at World Wrestling Federation, or WWE, I think it's called now. But he basically used the analogy that both political parties are actually similar to professional wrestlers. And he said when the TV cameras are on, they hit each other over the head with chairs. And then when the TV cameras are off, they're partying, drinking beers, and hanging out. So there's a lot of kabuki theater going on in public. But like Lee said, when push comes to shove, one of the major things that both political parties agree on is they want to increase spending. So whether it's Republicans with central planning, supply side economics, or Democrats with tax and borrow and spend, it's very, very similar. They're all central planning economics. I mean, even Trump, when he did the tax cuts and supply side, I mean, his government's he was still running large deficits. George W. Bush was running very large deficits.
Let's not forget that Trump also sent out checks to everyone.
He started it, yes, and then Biden added on to it.
Yeah.
And then Biden the Inflation Reduction Act was really it was an Orwellian misnomer, right? Because it didn't really reduce inflation at all. We got another spike because government spending increased even more.
Let's talk a little bit about government spending here. So in the 1980s, in the Reagan administration, they had the Packard Commission, and they did this study, and they found a couple of things that the government was like paying astronomical amount for. It was $435 for a hammer, $600 for a toilet seat, and then $7,000 for an aircraft coffee maker. And since then, a Harvard professor came out and said, "Oh no, it wasn't really the case. That it was really just the way the government accounted for things." But I mean, let's be serious here. I mean, do we have a government that's frugal? Are they good with money ever? Or are they really ever going to reduce their spending? It's just a total joke.
It seems that even the Republicans who are kind of fighting the debt ceiling raise right now, they're only fighting over the amount of increases in government spending. So it's not a real cut in government spending. It's just they're arguing over, I guess, the rate of increase.
Yes.
In government spending, because if you actually run the numbers, Lee, now at these high interest rates, post-Fed rate hikes the last 12 plus months, the interest payments on the debt, just saw the story, are now larger than the U.S. federal government defense budget, the official annual defense budget now. So in summary here, you have 3 or 4 line item expenses that make up the U.S. federal government finances. So you have defense budget, annual defense budget, entitlement spending, interest payments on the debt, and there's 1 or 2 other line items. And that takes up a very large chunk, the overwhelming majority now of the annual tax receipts. So that's kind of banana. That's not a world reserve currency, how the privilege of a world reserve currency should be used. That's kind of measuring like a banana republic.
Yeah. I mean, is there any doubt that we are one now?
Well, waste, fraud, corruption, and abuse across the board. This is more than a banana republic, because in a lot of aspects it is being mismanaged with corruption and other problems. But this is we hear a lot of Marxists and socialists use the phrase late stage capitalism. No. This is end of empire. This is big government corruption. Yeah. So yeah, there's large corporations, but they're government protected. They're paying the lobbyists. They're getting unbidden contracts. They're getting bailouts.
Jason, let's face it, we're not in a capitalist system. I mean, anyone who says that just doesn't really understand what capitalism is. And we have an entire economy that rests on the words of government, quasi-government officials at the Federal Reserve and what they're going to do with interest rates. I mean, that's macro control of the economy.
Yeah, or they were brainwashed by their college professor or textbook or the mainstream media using the phrase late stage capitalism. This is historic end of empire. So this is what you see if you're studying a Chinese dynasty towards the end of collapse, the Mongol Empire, the Roman Empire, the British Empire, you see all this stuff where there was a welfare warfare state, empire building, a central bank, bureaucracy, just waste, fraud, corruption, abuse from bureaucracy, protected large companies that they were chartered cartels, basically.
Like the Dutch East India Company and its predecessor.
Well, those actually preceded the Industrial Revolution. So those government protected chartered companies, those cartels, government protected monopolies, or a couple companies protected by the government preceded the Industrial Revolution. So a lot of people aren't even aware of that.
Yeah, no, that's true. People just don't know their history. So should we move on to JP Morgan a little bit?
Well, actually, I wanted to talk about bail-ins first, because we got a listener who sent me an extra tip there, and he was kind of asking, and this ties in with the banks too.
Of course.
So we can also talk about the banks as well. And he was asking, he was like, wasn't bail-ins supposed to have been legislated into effect with Dodd-Frank? Why wasn't there bail-ins? So actually, I had a minority opinion about this once Dodd-Frank was passed, and I had to look up when Dodd-Frank was passed, because I knew it was after the 2008 financial crisis.
It was 2010, I think, right?
Or yeah, it was enacted in 2010, and so basically, I was one of the larger and early adopters here with financial YouTube, and I was competing with all the other financial YouTube people, and they were all getting enormous clickbait and views, making these bail-in videos as soon as Dodd-Frank came out. And they're adamant that the politicians, the central bankers, all the people here in DC, the Treasury Department, the Fed, were all going to adhere to Dodd-Frank, and they were going to stick to the bail-ins. Well, Lee, after Silicon Valley Bank, 2 months ago, it lasted about 48 hours. the official bail-in legislation lasted about 48 hours until the majority of depositors at Silicon Valley Bank, who shockingly had, I guess they didn't either know or read or bother to read, maybe because they're so rich making money in Hollywood or Silicon Valley or elsewhere.
Yeah, I mean, those are all the venture capital guys in Silicon Valley.
There was a lot of Hollywood actors there too. Yeah, I mean, and didn't Prince Harry and Meghan Markle, they had a lot of cash. I think they had millions of dollars way over the FDIC limits. So I guess a lot of people didn't bother reading that there's a $250,000 FDIC limit. And so as soon as they realized, oh shit, there could be bail-ins, and we're going to be the ones, because we're way over the FDIC guarantees of 250,000. We're going to be the ones getting the haircut here with a bail-in if the government actually sticks to the laws, because the richer depositors, they're going to be the ones taking the big haircut now. They're going to be the ones getting an amputation, financial amputation immediately. Right. So, of course, they were the ones who were calling up their congressmen and talking to the U.S. Treasury Secretary or whoever. They're working their political contacts and their financial industry contacts, and they were the ones who forced the laws to change. So I know how unfortunately, because I've lived here over 20 years in the DC metro area, and I know bank lobbyists. I used to have conversations with them years ago before the guy moved. Well, I was friends with a bank lobbyist for years, and the guy moved out of the area. He just got fed up with it. But yeah,
shocking.
He was from a banking family, and he was here for a while, and he made a lot of money, and he just got fed up with it. But when push comes to shove, especially post 2008, Lee, I mean, when things get difficult here, especially for the politicians and their rich constituents, or too many of their smaller voters, especially if you're a Democrat, put pressure on them. I mean, they're gonna balk at the law change. So you had all these videos come out, though, YouTube videos that Dodd-Frank has changed things. There's no more bank bailouts. There's going to be lots of bail-ins, and people are going to get screwed. Well, there's a lot of issues there with if the DC politicians, and global macro ones too. So there's micro and macro issues with bail-ins. If you're a Democrat politician and you adhere to those bail-ins, Lee, do you think that the voter is going to vote for your reelection?
Yeah, probably not. I mean, I know there have been bail-ins in other countries, but I'm in complete agreement with you on this. I just don't think they're going to happen. I think they're just too much pain. They're too in your face, and the much simpler solution is to do bailouts.
And the average person isn't going to even understand or feel the pain of a bailout immediately. Could take many years. I mean, look at all the shenanigans that the Federal Reserve Bank and the U.S. federal government with the spending got away with for the last almost 15 years prior to the Fed rate hike, prior to the repo crisis in 2019. I mean, really from 2010 or 11 to the repo crisis, I mean, they were getting away with tons of quantitative easing, keeping zero interest rate policy low. And Janet Yellen and the other talking heads, the Fed people that are always wrong or lying, were routinely going on TV and saying, I wish there was more inflation, even though the reality was there was in the real inflation rate was way above the 2% or 3% target the Fed was saying. But on the macro level, Lee, and this is another reason why I do not think there will be wide-scale bail-ins in the U.S. banking system. The U.S. would run the risk, the U.S. federal government would run the risk then of the reaction by foreign governments and foreign central banks, similar to what happened when the U.S. federal government did the policy sanctions on the $300 billion of Russian foreign reserves. So we were discussing this before we started recording. I have said that was, it was foreign policy. It was a foreign policy decision by the U.S. federal government to confiscate the reserves. But the financial equivalent, it ended up being basically a haircut or a bail-in. That's $300 billion that Russia owned. That's gone.
Yeah,
it just evaporated. It's gone. Russia's not going to get it back. Mm-hmm. So all these other non-G7 countries, non-G7 central banks said, hey, wait a second. If we do something that the U.S. doesn't like, they can steal our U.S. treasuries. They can steal our assets in the United States too.
Right.
So that's basically the equivalent of a bail-in. So
it's absolutely horrible. I mean, really, it's nothing short of theft. And bail-ins and bailouts, you know, these are people who were not responsible for the collapse of the bank. Even their depositors were not responsible. Yeah, they took a risk in depositing the money there. But the taxpayers certainly weren't responsible for it. You know, it's really stealing money from people.
Both of them are. Yeah, both of them.
Yeah,
but
absolutely.
Our point here, Lee, is that both of them are wrong. And the bailouts are actually worse in the long term because they allow the bankers to just get away with like hedge fund. If they're a large, too big to fail bank, the banks have moral hazard. No senior bankers going to prison. And Absolutely. Then they're betting on a bailout, and then they're just making these crazy gambling bets, and they're betting that they're going to get bailed out and keep their bonuses, and no one's going to prison. So it just creates moral hazard. And then in the long run, the bailouts are actually worse because for the average citizen, they just devalue. The bailouts are actually worse because they devalue the dollar. And then the average person, the small business owner, the person, middle class person, their standard of living is going to be totally destroyed in the long run. But if you're a politician, if you're a government official, if you're a central banker, you're betting that most people aren't even going to notice this or think about it for many, many years, or you're going to be retired. You're going to be out of office. So if you're a politician and you've already done your side deals for 10, 15, 20 years since 2008 financial crisis, you're thinking of retiring. I mean, you can cash out with your golden parachute. Same if you're a senior banking executive.
Oh, no, absolutely. Yep. No doubt about it. I mean, where's Alan Greenspan these days? You know, like all these guys, they kick the can down the road and then they retire before it explodes.
Well, but Greenspan, before the repo crisis, actually, he started to be honest again. He started talking about stagflation and how people should be hedging with gold. He started switching back to being honest again about that. So, in terms of like the macro call, though, for the bail-ins, and this is why I'm and for years, really, since all those YouTube videos were getting all those views, way more than my YouTube channel about the bail-ins. They were getting like tens of thousands or hundreds of thousands of views. There was the larger YouTube channels were just making these bail-in videos nonstop, and like the government's going to adhere to these bail-ins. You're going to lose 30, 40, 50% of your bank account overnight. It's going to be gone. And I was like, no, they won't do that because you would have the global macro equivalent similar to what Russia had to, what other governments saw, what happened to the Russian $300 billion, the confiscation of their foreign exchange, their Russian reserves. And so if you do the bail-ins at that size, Lee, internationally, it starts to hurt demand for dollars. It starts to hurt people's confidence in the dollar more.
Oh, absolutely.
Short-term bailouts. So if you do haircuts on the dollar, people are going to say, hey, wait a second, the U.S. is not honoring private property laws. The U.S. is confiscating stuff. They're confiscating our assets. Those assets are gone. They're picking who gets destroyed immediately, who gets a financial amputation immediately. What I was just going to say is that would, if they went the full bail-in route, like rapidly and actually adhered to Dodd-Frank, that would weaken dollar strength internationally, and then the dollar usage internationally would be rapidly reduced at a faster clip than it currently is.
Well, I mean, the capital flows to the U.S. would just dry up overnight if they started going down that road, I think. from foreign countries.
And things are heading in the opposite direction. Lee, they're talking now about extending the FDIC limits above 250,000.
Yeah.
So if you're corrupt, so if you're a drug cartel or a corrupt politician or a corrupt foreign business owner, and you've been stealing government contracts or other foreign currency, you launder your foreign currency into US dollars, you get it here to a US bank account, and then the FDIC raises the limit to $500,000 or $750,000, your cash is guaranteed once it's laundered here.
Yeah. So, getting back to the Silicon Valley Bank and JP Morgan, I don't know if you knew that 90%, it's estimated about 90% of Silicon Valley Bank's venture capital clients moved over to JP Morgan after this. So
shocking. Well,
they gained, JP Morgan gained something like 50 billion in deposits in the wake of Silicon Valley Bank's failure.
So that would be out of fear. So those deposits would be the fear. The greed deposits that left the regional banks, so Silicon Valley and the other regional banks, those are going into the higher yielding money market funds.
Right.
They're going into directly U.S. Treasuries. They're going into those. I
mean, let's face it. JP Morgan seems to make out every time there's any kind of financial crisis. I mean, they also picked up First Republic for a fire sale, and you go back to 2002, 2007, 2000. Actually, so let's play this out. From 2004 to 2006, the Fed just raised rates like crazy. They went from, I think, 1.25 to 5.25, something like that. Then they started dropping them in 2007, 2008. And in March of 2008, Bear Stearns got sold because they collapsed. I don't know if you remember the Bear Stearns collapse. But JP Morgan Chase bought them for $2 a share. And the share price of JP Morgan had hit a high of 171.50 just a little over a year prior to that. So these too big to fail banks can really deteriorate fast. And it seems like JP Morgan always is at the center of this, and not only in 2008, but back in, it was 1917, there was a crisis, and JP Morgan himself was involved in coordinating a bailout of the federal government. And
I think it was 1907, because I think by
1907,
because JP Morgan died before the Federal,
you're right, it was
Federal Reserve Act came in past. Yeah, it was one of his last wishes.
Yep. So it seems like JP Morgan kind of runs things. And getting back to the whole debt ceiling thing, I know Janet Yellen is supposed to meet with the Bank Policy Institute, and that is composed of JP Morgan, Goldman Sachs, Wells Fargo, Citigroup, and a few other banks. So, I mean, they're running the system. I mean, is there any doubt about it?
Well, also, if you look at the deal with the First Republic deal, you had the Federal Reserve Bank and the FDIC made it so JP Morgan got all the good assets discounted. So they got it subsidized at taxpayer expense. And then they got none of the toxic or radioactive liabilities. So they got to pick and choose all the good assets. They got cheap capital to buy the good assets, and they got legal protection so they didn't get stuck with any of the toxic liabilities. This is wonderful for them.
Yeah, so let's talk. Can we talk about the markets a little bit? What's been going on there?
You want to talk about the general stock market or the earnings about Home Depot?
Well, let's talk a little bit about both, because I think they tie into each other. I mean, we had a pretty good run the past like month and a half, 2 months, something like that. And, we kind of came in, but then we had a rally, but the market breadth has just been absolutely horrible. And for those who don't understand what market breadth is, it's basically the number of companies that are moving along with the market. So the better the market breadth, the more companies are going up, and the worse the market breadth, it's fewer and fewer companies that are actually driving the shares.
So it's advanced decline. So if it's a bull market, then you're going to have more companies, so small caps, mid caps, making higher highs than in a bull market. Whereas
go ahead.
So whereas in a bear market, then you're going to have a bunch of companies, probably small caps, because interest rates are higher. You're going to have them lagging, and then you're going to have people going into safer defensive plays. So the large banks like JP Morgan would be safer relative to regional banks or other defensive the typical Warren Buffett defensive stocks, although with Berkshire Hathaway. Even Warren Buffett at his annual shareholders meeting for Berkshire Hathaway, I mean, he gave a lot of warnings about his American companies, his consumer discretionary companies, about the state of the U.S. economy.
Yeah, and you mentioned the advanced decline. The New York Stock Exchange advanced decline line last week broke below its 50-day moving average, and that's usually like, I mean, it's a red flag. I mean, if it stays below there, it's a bigger red flag, but it's definitely something to think about. And it's also May, and there's an old saying, sell in May and go away. And I think it'll prove to be true this year as well.
Well, plus we also have the debt ceiling issues. You have the Fed, which may or may not raise the rate hikes one more time, another quarter point. But I think the damage is already done, even if the Fed cut rates at this point.
No doubt.
On our last show, definitely go and listen to what we said about the banking system. Yeah, we've had a small little short covering rally in the regional bank shares, but there's still a lot of banking system problems, and they're not going away. All you have to do is just look at the problems with consumer credit card debt, problems with bankruptcies from a lot of companies not being able to repay their small business loans. And then there's a lot of evidence that the U.S. consumer is tapped out. Go and look at the Home Depot earnings that came out recently, and then just look at all the headlines are still coming out about commercial real estate, but the real pain for commercial real estate hasn't started yet either.
You know, just quick note on Bear Stearns and the Federal Reserve, and you said the damage wasn't done yet. It took about a year after the interest rates had hiked up for Bear Stearns to collapse. So they had hiked up the interest rates, then they started to decline them, reduce them, and from the point of the peak of the rate hike to Bear Stearns collapse was a little over a year. So the pain is yet to come, because we don't even know if they're done with the hiking cycle. And you also mentioned credit cards. There's about 148 billion in debt that was added to credit cards, and it's an increase of about 17% year over year to credit cards. And I think we're starting to see the end result of just people getting tapped out. Obviously, the credit card issue illustrates that, but also Home Depot, first time since 2009 that they had a yearly sales drop. And let's not forget Bed Bath & Beyond just going into the great beyond. So I mean, the consumer out there is getting squeezed
through stagflation, years of stagflation, and I think this is important to talk about. Even a low inflation rate is really, really bad over longer periods of time. So the average person who's not a financial expert might say, oh, big whoop-de-doo, it's a 2% or 3% inflation rate. Well, if we've had a 3% inflation rate since 2009 or 2010, and according to Shadow Stats, I mean, the inflation rate, I would call that a low-level stagflation. But if the real inflation rate was above the Fed's target at 2% for many, many years, it only takes at a 3% inflation rate. And in finance, there's something called the Rule 72. And basically, you take the number 72 and you divide it by an inflation rate, and that gives you the amount of years it would take for your purchasing power to be cut in half. But you can also use the Rule 72 for other things. So basically, at a 3% real inflation rate, it only takes 24 years for your purchasing power to be cut in half. At a 4% inflation rate with the Rule 72, it only takes 18 years. At a 6% inflation rate, Lee, which is what we have now or right around now, and the real inflation rate was way higher than 6% for over 18 months. But according to the Changing Propaganda Index, the inflation rate is still close to 6% right now. I think it's mid fives, I think, or right around now, give or take.
Right.
But at a 6% real inflation rate with the Rule 72, your purchasing power is cut in half in only 12 years.
It's crazy.
And this is the problem with Stackfly Tax Lie. I mean, the big government politicians, the banks, all these players have benefited from artificially cheap interest rates and Stackfly Tax Lie for many years, and the Cantillon effect, because they knew it was happening. They inflated asset prices, They inflated stocks for many years. The stock market's still artificially high. I mean, there's tons of red flags, and a lot of especially the 4 or 5 large cap tech stocks, which are propping up the market. I mean, you just see all these traders talking about how well the NASDAQ is doing. Well, it's only 4 or 5 stocks.
Well, yeah. Well, Alphabet is a good example of that. I mean, they had I think they beat earnings. it was supposed to be $1.08 was like the whisper number, whatever. They came in at 117. Apparently YouTube, they got 6.69 billion in advertising. And it certainly isn't going to the content creators. I could guarantee.
Yes, it's not going. It's not going to me.
But they're spending 70 billion in buyback over their stocks. So I mean, is there any wonder why the Nasdaq's going up and the rest of the stocks in the world are not?
And it's only a couple of companies that are propping the Nasdaq up, so it's not a wide breadth like you're saying.
Very narrow. Yeah, absolutely. So I read a funny story. We were talking about Home Depot and the issues in retail, and we've seen Sports Authority go, we've seen Toys R Us come and go, we've seen Radio Shack. I mean, it's been these big companies. Now latest is Bed Bath and Beyond. But I read a story that pickleball is starting to pop up in these malls because they've got nothing else to put in there. I mean, retail's dead. Brick and mortar retail is pretty much dead, and unless it's a consumable item that you need right away. I mean, Home Depot is kind of lucky that if you're working on your house and you need something, you're going to run to Home Depot and get it. But something that you can order online, you don't need a brick and mortar store for anymore.
If there's less consumer discretionary spending, you're also going to see more bricks and mortar store closures. So you're going to see retail stops, retail shops, they're going to reduce their commercial real estate. They're going to close their amount of stores. They're going to try to focus on selling more online instead. You're going to see a lot of restaurant locations that are going to close down because the consumer is not going to have as many discretionary spending. So you're going to see all that happen. And inflation and taxes have driven that. And then on top of that, when the Fed raises interest rates, then that's going to cause an Austrian boom and bust cycle, an artificial boom and bust cycle. And then the companies then with the higher interest rates, they're going to have to adapt to that. So they're not going to be able to keep as many stores open or fund as much expansion as they would have in the past.
Absolutely. You wanted to talk about oil, natural gas, uranium, etc.
Well, actually, I wanted to talk about deflation first. So with the Austrian boom and bust cycle, so we've when you have all these experts now on all these different financial YouTube and podcasts and people warning people that deflation is the thing that you should be worried about. So in the real world here, the average American consumer still has to deal with stagflation, shrinkflation taxes that are way above the changing propaganda index number that's happening. So I mean, taxes are still going up. All these bills are. I just hear stories about how people's insurance bills are up 12% and all this other stuff. And then stagflation and the changing propaganda index or CPI does not track any of the shrinkflation at the restaurant, or it doesn't cover any of the stuff accurately or cost per unit. They intentionally have the PhD economists and the interns they send out to Target or Walmart or Whole Foods here in DC. They don't track any of that stuff.
No, of course not. And the market basket they use to track inflation changes just to make it not seem as bad as it is. And they've been doing that for decades, really.
Yeah, I just wanted to add one more comment here, a general theme here on deflation. So we've talked about deflation, how governments hate it because they can't tax it. It means falling asset prices. It means bankruptcies. It means the consumer's not going out to eat and shopping as much. But inflation and deflation are related. So if you have too much inflation, that destroys people's standard of living. And then if the Fed raises interest rates to fight that, that creates an artificial boom and bust cycle, the bust part of the Austrian theory of the business cycle. Excuse me. And so then on top of that, then you could potentially have bankruptcies. The problem with deflation, Lee, and why it cannot last for a long period of time is that really the entire global financial system, when you add in fractional reserve banking, when you have debt-based fiat currencies and just insane amounts of credit growth in the real economy and government spending in so many of these economies, deflation for long periods of time means total collapse of the system. So that's why you have all these currency swap lines from the Federal Reserve Bank. You have rules changes, goalposts moving, secret bailouts. You have all these liquidity programs installed because deflation, not only does it mean collapse in tax revenues for the government, it also means potentially in a debt-based fiat currency system with insane amounts of credit growth for many decades, and then fractional reserve banking with the banks. And a lot of these banks, Lee, were their They were fractional reserve banking at way over 10-1. I mean, some of them, if you looked at their balance sheets, some of these regional banks, we had a hedge fund manager when I interviewed him, Brian McCarthy, or former hedge fund manager, Brian McCarthy. And he was talking about some of the regional banks, their balance sheet there, and they had what, 5 billion in tangible book equity and 77 billion assets. That's like 15-1 leverage. So that's over that. That means then that they're not even at the normal fractional reserve banking leverage.
And is there any wonder why these banks fail spectacularly when they do?
Well, you got to blame the Fed, because it was Pavlovian response, because they were trained for almost 15 years. They were trained to expect artificially low interest rates. And then if they're a First Republic bank, they gave out jumbo mortgages at 3%. The problem is now a lot of these banks are underwater on any of the loans that they gave out at 3%, because the Fed raised interest rates so much. If they're a regional bank, they have depositors fleeing for greater fear. We talked about on the last show all the bond losses that have not been written off yet. So your insurance companies, your pension funds, your banks, they have just insane amounts of bond losses across the board, and they're not marking these down yet. There's been very few markdowns on bond losses so far. So as long as the Fed keeps interest rates at these levels relatively higher, keeps raising, I mean, there's going to just be, at some point, they're going to have to start writing off these losses. And they can't, all these entities, they cannot hold to maturity all these assets, like a lot of the
oh, absolutely not. Yeah,
a lot of the bond, either current or former bond fund managers or Fed apologists or deflationistas are claiming. So yeah, we can have deflation in this. My point, though, especially post 2008, with all the bank bailouts and all the rules changes, currency swap lines, all the crazy liquidity programs that have just happened with the 2019 repo crisis, there is deflation. It just doesn't last very long, because the people in power realize that once one or two large banks fail, then other banks start to fail, and it just creates this domino effect. And so they decide that they're not going to let any banks fail. They start changing the rules, liquidity programs. Well, at some point, this is why we need a new system.
Yeah. Unfortunately, I don't think we're going to have one until this one completely collapses. You know, I know, and one thing we were talking about a couple days ago were the rating agencies on the bonds, the government bonds. Remember, and you mentioned Egan Jones.
Oh yeah, I wanted to bring that up. So this is why you will not see any of the major bond rating agencies potentially downgrade the U.S. government credit rating agency. For our listeners who don't remember or are not familiar, there was a independent one that was not one of the big three. So I think the big three are Moody's, Standard & Poor, and what is it? Standard Charter? Is that the third one?
I don't remember off the top of my head.
Anyway, to be an official government bond rating agency, you need a license. So once you have a license from the government to rate their own bonds, which I don't know, wait, nod, right? And Warren Buffett loves investing in these companies. I guess because they kind of have, he calls it a moat, but it's like they have government protected monopolies or oligopolies or whatever. But these guys are not above board. They rubber stamp the mortgage-backed securities. So a lot of the stuff they do is shady. Anyway, though, there was an independent bond rating agency called Egan Jones back in 2011, and they actually had the chutzpah to downgrade the U.S. federal government on one of the debt ceilings, and they downgraded the credit rating. And then I think they were properly fined and investigated by almost every single U.S. federal government agency over the next 12 to 18 months.
IRS, SEC, pretty much everyone.
Every single one. Lawsuits, fines, investigations, knocks on the door. So basically, that was the U.S. federal government sending a message that, I don't think anyone should downgrade us unless you want the Egan Jones treatment.
Exactly. Oh.
So that's why, for people who are wondering, why hasn't the U.S. been downgraded? What happened to Egan Jones back in 2011 is why Moody's, Standard & Poor, and Standard Charter are not going to downgrade them.
We basically are living under a mafia.
And apparently the global financial system, it is controversial to say it, but it resembles basically a Ponzi scheme. With debt-based fiat currency, the way the money supply has grown enormously, the money supply growth for decades now, the way credit has grown for decades. I mean, this credit all this debt cannot be mathematically paid off, and yet it has been rolled over and it still grows. And now here you are.
Yep. I said it continues and it grows.
Well, look at the debt ceiling and look at the size of the U.S. national debt. They go hand in hand. There's no discipline whatsoever from either political party in DC, but this is what happens when you have the world reserve currency and then you're on a debt-based fiat currency with credit growth, and you can export all those dollars outside the United States for decades. There's no immediate consequences to currency debasement.
For years, you would watch the news and you see these third world countries act irresponsibly, and the news would be, just kind of making fun of them and how did they do this? How did they spend themselves into bankruptcy? Well, when you have the world's reserve currency, you can get away with it for a lot longer.
This is another.
It'll end.
So another thing that a lot of people who have been predicting, and the Austrian school was guilty of this too, historically with hyperinflations, especially the last 120 years, a lot of the hyperinflations that have happened to countries that either owe war reparations in a different currency, so in a foreign currency, or they have dollar denominated debt and they can't print it. So it's like an emerging market government, and their banks and their government and their corporations over borrowed in dollar denominated debt, and then their currency gets weak, and then that's how they have currency problems or a currency crisis. But then if you go back and read the book that John Rubino and James Turk wrote 6 or 7 years ago, and I interviewed John Rubino about this, James Turk was an investment banker for decades before he started Gold Money. And he was talking about how the Fed was also secretly doing bailouts with currency swap lines with those emerging market governments to save the large banks that had problems in those countries. The U.S. banks and European banks that had bad investments in those countries to prevent banking contagion. It's just the currency swap lines back then, Lee, were not for hundreds of billions or trillions of dollars. So they've been scaling up as the global financial system has been scaling up in currency growth and credit growth and over-the-counter derivatives growth.
Mm-hmm.
And now here we are. We're tens of billions of dollars for a bank is not that big anymore.
Yeah.
Now, First Republic Bank, they're not even one of the largest 10 banks, right? And that was over $100 billion. But these too big to fail banks, I think JP Morgan, aren't they? JP Morgan's larger than most countries now.
I'm sure it's bigger than almost every country.
Actually, I think I read that they're larger than the People's Bank of China now. So they're that big.
Yeah. Well, I mean, they pretty much run our monetary system and government. So, as we've seen, everything kind of favors them when anything goes wrong. And it's been over and over again for over 100 years. So I don't see that changing anytime soon. So where would you think of investing your money? I mean, are you thinking of oil, natural gas, uranium, that type of sector, or are there other areas you're looking at?
So every day I always ask myself, Monday through Friday anyway, on the weekends if I have extra time and I'm not going out, what's cheap and what's hated? So as a contrarian, I'm looking for stuff that has good fundamentals, but the market valuations on those are hated, or not liked at least. And what's cheap and what's hated now? Fertilizer companies. So your larger fertilizer companies here in the US, they have cheap natural gas. So if you're a Nutrien, you're a Mosaic, Intrepid Potash, CF Industries, you have much cheaper inputs. You have cheap natural gas to make fertilizer and export that at higher food prices in other countries. So that's cheap and hated. I think the valuations on those are pretty reasonable. Are they going to guarantee short-term winning trade? No. Over a couple of years, probably good contrarian swing trade. And then oil companies. So what companies that have a mix of oil and natural gas, a lot of these oil producers, they can still make pretty good money around 70, unless they're deep water offshore company producer and they're higher cost, or they have a bad balance sheet or something, too much high cost debt. There's a lot of oil companies right now, Lee, that have price to earnings ratios at 5 or lower. They have pretty good growth that they can add. They can grow low cost oil production with some natural gas byproducts of natural gas rallies. Are going to benefit from that too. And they have pretty sizable dividends. So there's a lot of oil and natural gas companies. So these are like the small, medium, even some of the large producers outside the United States have pretty favorable valuations at a price to earnings ratio of 5 or lower now.
So I just looked up Alphabet's, which is Google's PE ratio. It's 26.62 as a market comparison.
Well, Warren Buffett's not the best market timer, but I think he just bought another $125 million worth of Occidental Petroleum. So there he is kind of a pretty good contrarian. I mean, Warren Buffett's not buying bank stocks right now. I think he's trying to, after that secret meeting he had with the Biden administration, I think back in March.
Trying to unload his shares in that sector because I know he's been heavily invested in it for a long time.
Well, actually, what's funny is his favorite bank stock for many, many decades, I think, was US Bancorp, which is symbol USB. And they were actually applauded in the last banking crisis, 2007, 2008, 2009, for not having residential real estate exposure, that, they only focus on efficient and productive American businesses and commercial real estate. And now here we have this cycle, and that's what they're exposed to. And the shares are down 40% in a year. And there's like red flags. If you look at that 1-year chart on US Bank, and they're a sizable bank, I think they're top 5 in the United States for commercial real estate loans. They're really big. Really big exposure.
They're hurting. I'm looking at the chart right now. They are hurting.
And that was other than Bank of America and Wells Fargo, that was Warren Buffett's favorite bank stock, was US Bank. So he used to talk about them all the time. I think he sold most of his shares a while ago.
Right. I'm sure he got out when he saw the writing on the wall and what was going on in the world. Yeah, I think Buffett's too big to time the market. He just has too much assets under management. He has to kind of ease in and ease out of positions over time. So he can't just capitalize on large market swings and just move in and out, generally speaking.
Yeah, he can't buy small caps anymore. So for our listeners who are not familiar, when he first started managing money, he used to buy a lot of small cap companies, and then he produced unbelievable returns over 2, 3, 5-year periods buying small caps. He said he's too big now to buy those. He'd have to buy the entire company, and it still wouldn't move the needle for his returns. He's just too big to do stuff like that. Yeah, but there's a lot of good value though. Small and medium size, even some of the larger oil and natural gas companies outside the United States. So like Petrobras and Ecopetrol in Colombia, there's geopolitical risks there, but like the fundamentals of the company, the dividends, there's pretty decent risk reward. Suncor in Canada. I mean, there's the Canadian Natural Resources in Canada.
I just want to say one more thing about back to JP Morgan and Jamie Dimon. He suggested that they outlaw short selling of bank stocks.
I mean, they pulled this stuff in 2008 and 9. So for listeners who are not familiar, they pulled this stuff in 2008 and 9, and a lot of the banks crashed anyway until they changed the accounting laws for the large US banks. They didn't have to mark to market losses. They can mark to model. Not all banks, but just like the too big to fail ones. So your Bank of America, Wells Fargo, JP Morgan, Goldman Sachs. Those guys, back then, Goldman Sachs actually changed over at least one of their parts to a bank holding company to get extra access to capital. I think Morgan Stanley did it too.
Well, I mean, just the whole concept of outlawing short selling is just stupid, because when a stock crashes and no one wants to buy it, the people who have to buy it are the short sellers who already sold it, and they got to buy it back to get the shares back. So they're the true plunge protection team for stock, the short sellers. And to eliminate that would just be a disaster if a stock started falling. I don't even know what he's thinking. I mean, he runs one of the largest financial institutions, if not the largest in the world, and he doesn't know this. I don't get it.
Maybe he wants to unload more of his shares into a rally. There was a couple hours ago, we found out some information that $22 million of insider selling of JP Morgan bank stock recently.
Yeah, they know something. All right, let's call it a night there, Jason. I think we covered a lot of stuff tonight.
Yeah, let's just we can talk about gold and silver. I think gold and silver got paper price smashed. I mean, I've just been reading some of these headlines that gold and silver sell off on confusion over debt ceiling. It's like, wouldn't people be buying more gold and silver over problems with the debt ceiling and the dollar, and not knowing that potentially no one's going to downgrade the US as of what we said with Egan Jones, but like problems with the dollar or other problems normally in a bankruptcy risk environment or uncertainty, geopolitical risk, gold and silver do well, but of course they were paper price smashed down.
Oh, no doubt about it. I mean, I still maintain, and I think gold and silver in a very long-term bull market. They've been consolidating basically since back in the early days of COVID. But I think they're getting primed to break out of their trading range, and we may see a little bit of a pullback here, but eventually we're going to see it. I think gold easily break through its high this year.
Well, the other thing I wanted to talk about was the VIX, and the VIX is, I think, down around 17, which is shocking. Just I know the general stock market indexes look pretty calm, but there's so much violence below the surface. I mean, the sharks are circling. The sharks are circling with a lot of, whether it's problems with the companies and earnings, it's it's the Fed raising interest rates more, it's the banking system problems, commercial real estate. There's all these problems here beneath the surface. So for the VIX to only be at 17, I know there's a leverage short volatility train, and it's in the best interest of these portfolio managers at the banks and family offices. And this leverage short volatility trade is over 3 trillion in size to try to smash the VIX. But if the VIX spikes, Lee, I think we could have another kind of problem here with hedge funds and family offices blowing up.
Well, I mean, the VIX is kind of like in the middle of its trading range right now. It had a big spike back in early, like mid-March. That was the last time it spiked, although it did spike early May, but it wasn't seriously as high. I think as long as the markets go up, that VIX is going to fall further. I mean, it's got room to go. I could easily see it go down into the 16 range. High 15s maybe.
And as we wrap up here, hopefully our listener who emailed me asking about bail-ins, hopefully our questions were answered. But unfortunately, because I've been here over 20 years, and especially post 2008, and seen all the crazy stuff that has gone, that the governments and central banks have gone away with, especially the Federal Reserve Bank and the U.S. government, both political parties too, they just don't adhere to the laws. So when push comes to shove, when the going gets tough, they just change the rules.
Well, they make the laws, so basically, right?
Yeah, this is something that the average person just doesn't understand, is the amount of lawyers here and people with law degrees here, and the lobbyists on K Street and the DC metro area and all the law firms. I mean, there's a revolving door of a lot of lawyers at these government agencies, and then they go and work at a lobbying firm or for a large corporation. So it's just a revolving door of corruption, how to work the system, how to change the laws, how to find legal loopholes, how to do all these crazy things. So just because a law was enacted, Dodd-Frank, and I don't know, if I would have made all those clickbait videos with bail-ins back then, my YouTube channel would probably be 5 times larger. But I honestly wanted to stick to my guns here and say they weren't going to do that. They weren't going to adhere to the bail-in laws. They weren't going to immediately take 20, 30, 40% of people's bank accounts immediately. They may selectively do that, but I don't think they're going to do it wide scale, because they still have the world reserve currency. The dollar strength is still relatively strong, and they don't want to hurt that. So they do not want to hurt the dollars to do international transaction. The dollars used in global trade, they don't want that rapidly declining.
Yeah, definitely not.
And doing a large-scale bail-ins, so allowing the banking system to just do bail-in, 30, this bank fails, 20, 30, 40% of your bank accounts or more are just gone. That would internationally just hurt confidence in the dollar and demand for dollars. So I don't see them doing that, especially when the path of least resistance is rules changes, goalposts moving, hidden liquidity programs, covert bailouts, no Fed audits, no generally accepted accounting principles for the Federal Reserve Bank, even though the Federal Reserve Bank is cash flow negative. and if the Federal Reserve Bank had to adhere to generally accepted accounting principles,
forget it
would be insolvent.
Yeah, forget it. So, all right, Jason, it's been a great discussion as always. I look forward to our next time.
And thanks everyone for listening. Again, this was episode number 20 of Finance Unspun.